Hello everyone. Intel just lost a staggering $100 billion in only 48 hours, not due to a crash, but because Beijing flipped a switch. Overnight, the king of chips became the most vulnerable pawn in a global tech war. One quiet decision in Beijing, carefully planned, has hit Silicon Valley at its core. And with a single move, China is threatening to unravel the foundation of America's chip empire. On April 12, 2025, China's Ministry of Industry and Information Technology issued a subtle but seismic policy change. The directive prohibited government agencies and state-backed companies from buying chips made by U.S. manufacturers, including Intel, AMD, and Micron. The reason? National digital sovereignty and risks to the supply chain. Within hours, procurement systems were reprogrammed. By the next morning, major contracts with entities like China Mobile, State Grid, and vendors linked to Huawei were nullified. Intel, which had earned nearly 27% of its 2024 revenue, about $22 billion, from China, saw its stock nosedive by 18.3% by the close of trading on April 14, according to Bloomberg. Traders weren't simply reacting to lost sales. They were pricing in a much larger threat: a complete Chinese phase-out of U.S. semiconductor supplies. But what if this wasn't just about chips? What if the real target was U.S. innovation itself? On the surface, Beijing's move looked defensive. But beneath it was a surgical strike. According to Emily Jin, a geopolitical analyst at the Center for a New American Security, this wasn't just economic decoupling, it was deliberate erosion. Intel's dependence on Chinese customers made it an easy target. Unlike Nvidia, which earns only 19% of its revenue from China and has diversified partnerships globally, Intel still relies heavily on selling PC and server processors to industries tightly woven into Chinese infrastructure. By pulling that one thread, China didn't just harm Intel, it disrupted the internal workings of America's most critical tech corridors. The ripple effects were immediate. Intel's collapse dragged down semiconductor ETFs like SOXX and SMH, triggering a 4.2% drop in the PHLX semiconductor index the same day, as reported by the Wall Street Journal. But Intel bore the brunt. Its vulnerability wasn't new, it had been building for years. In 2011, Intel held 80% of the global PC processor market. By late 2024, that share had fallen to just 57%, according to IDC. Delays in rolling out the 10 nanometers and 7 nanometers nodes allowed AMD to recapture market share. Meanwhile, Apple and Amazon started designing their own chips. Financial performance didn't help either. Intel posted a $2.88 billion net loss in Q1 2023 and laid off more than 1,200 employees in Q4 2024. So, when China pulled the plug in 2025, Intel had already lost much of its pricing power, dominance, and strategic buffer. As semiconductor policy expert Doug O'Neill at Rand notes, Intel's business model still operates under the rules of yesterday's globalization. Beijing just shut that door. But maybe this move signals something bigger, something China has been quietly building toward. There's a looming deadline that makes this policy shift feel more like a trigger than a reaction. According to internal planning documents reviewed by Reuters, China aims to purge all US-sourced semiconductors from public infrastructure, energy systems, and telecom networks by December 2027. Dubbed Clean Silicon, the directive mandates that by Q1 2026, 80% of central government computing systems must run on domestically designed chips. For Intel and its peers, this isn't just lost access, it's forced obsolescence in the world's second-largest tech market. Morgan Stanley now estimates that this policy could strip $350 billion in cumulative revenue from US chip makers by the end of 2027. And according to JP Morgan analysts, the long-term damage isn't just financial, it's strategic. If China can prove that the global chip ecosystem can thrive without American technology, other countries, Brazil, Indonesia, parts of Europe, might follow suit. Beijing isn't enforcing a ban, it's building a prototype for a post-American tech stack. To pull this off, though, China would need cutting-edge chips. And in September 2024, that's exactly what shocked the world. Tech Insights, a leading teardown firm, revealed that Huawei's Mate 70 Pro contained a domestically produced 5 nanometers Kirin chip, manufactured by SMIC. Using older DUV lithography machines and complex multi-patterning techniques, China produced a chip previously thought impossible without ASML's EUV tools. It flew in the face of US assumptions that China couldn't go beyond 14 nanometers. Meanwhile, Intel was still grappling with production issues at its Ohio fab and hadn't yet launched mass production of its 18A node. But Huawei didn't just build a symbolic chip, it worked. In just 6 months, they shipped over 45 million Mate 70 devices, according to Canalys. SMIC's revenue surged 47% year-over-year in Q1 2025, driven by state-aligned orders. In contrast, Intel's data center revenue dropped 22% in the same quarter. According to tech policy fellow John Bateman at Carnegie, while the US tried to bottleneck China's tool supply, China focused on scaling what it already had, and it worked. Now that Huawei has a functioning domestic chip ecosystem, replacing Intel isn't a matter of technology, it's just a matter of time. And this wasn't supposed to happen. The US had the tools, the patents, the suppliers. Yet somehow, Huawei leapfrogged every playbook Washington had, and did it without the critical components the US thought were indispensable. So, if Huawei can do this with smartphones, what happens when they target servers, cloud computing, or AI chips? What started as a dry bureaucratic roadmap in 2015 has now become one of the most ambitious industrial overhauls in the world. By Q1 2025, over 75% of China's strategic sectors, from aerospace to power grids, had already shifted, at least partially, to domestic semiconductor suppliers. Companies like Huawei, SMIC, and Lungsan are now receiving over $58 billion in state support annually. US firms like Intel are systematically being excluded from government contracts. Nina Xiang, founder of China Money Network, says it plainly: China isn't racing the US anymore, they're building a parallel system that doesn't need it. US chip imports into China dropped to 28% in 2024, down from 41% in 2021. Domestic firms now supply more than 55% of government computing contracts. The question now isn't if China can replace US firms, it's how soon they'll stop needing them altogether. So, can Intel respond before the drawbridge is pulled up for good? Or is that window already closed? The CHIPS and Science Act unlocked $52.7 billion in federal support, and Intel stands to gain the most, $8.5 billion in grants and $11 billion in loans, according to the Commerce Department. But the execution is lagging. Intel's Ohio megafab, Silicon Heartland, is now expected to begin partial operations in late 2026, nearly a year behind schedule due to zoning and construction delays. Meanwhile, TSMC is on track to begin 3 nanometers production at its Arizona site by Q3 2025. Intel's $8.2 billion deal with Amazon Web Services, announced in February, will help buffer revenues. But analysts at Bernstein warn it won't be enough to offset the $13.7 billion in annual revenue Intel stands to lose from China by 2027. As Morningstar's Abhinav Devuluri notes, government support might help stabilize Intel, but it can't accelerate Moore's law or undo lost time. So, what does this mean for the average consumer? Who pays if Intel falls further behind? The fallout won't stay inside boardrooms. In 2025 alone, Intel announced layoffs affecting 1,250 employees, mostly in Oregon and California, according to SEC filings. These cuts followed a sharp 19% drop in Q1 client processor shipments, driven by weak demand and lost international orders. Consumers are next. Leaked pricing roadmaps seen by Bloomberg show OEMs like HP and Dell planning 12 to 17% price hikes on upcoming models using Intel chips. Without China to absorb large-scale production, Intel must either cut output or raise prices. And this hits more than just laptops. Cloud hosting, enterprise servers, and AI hardware used in healthcare and logistics are all being repriced. This isn't an abstract supply chain story. It's one that will appear on your next invoice. Even with federal funding and price hikes, can Intel recover? Or is this just the beginning of a longer decline? Intel now faces a race between capital and relevance. With over $19 billion in CHIPS Act support and key deals with AWS and the Department of Defense, the pieces for a comeback exist. But investor confidence remains shaky. Intel's stock has underperformed the PHLX Semiconductor Index by 31% over the past year. Goldman Sachs recently downgraded the stock, citing compressed margins, execution delays, and rising foreign competition. More troubling is Intel's dwindling innovation-led. Its 18A node isn't expected to reach mass deployment until mid-2026. Meanwhile, Samsung and TSMC are already producing 3 nanometers chips and working on 2 nanometers prototypes. Former CEO Pat Gelsinger, now serving as a strategic advisor, summed it up in a March CNBC interview: "It's not about winning a quarter, it's about staying in the game for the next decade." But to stay in the game, Intel must first restore its technological credibility, and that remains elusive. And if you think Intel is the final target, think again. This isn't about one company. It's about who gets to lead in the next tech era. Beijing's next move. A full-scale export ban on rare earths like gallium and chips used in AI training. Washington will respond, but it might already be too late. Because behind all the headlines and stock charts lies a deeper question: can the country that invented semiconductors survive its own dependence on foreign supply chains? We're glad you're here. If you found this insightful, please like and subscribe.